According to the IMF, governments borrow to spend beyond what they can or want to raise through general taxation. They borrow when revenues are down and they have to pay for existing commitments. Governments also borrow to spend on infrastructure like building new highways and laying new railway lines. And they borrow money from both domestic and foreign fronts. At the domestic front, they borrow from banks, asset managers, or directly from households. And at the international front, they borrow from global capital markets, from governments, or from international organizations. So when the government fails or refuses to repay the full debt when it is due, it is called a sovereign default. And unlike companies, the governments cannot be taken to bankruptcy court for debt recovery. Like in April last year, Sri Lanka declared the country was suspending payment on most foreign debt. Later, several leading credit agencies said that the country has defaulted. Our another neighbor, Pakistan too, has been teetering on the brink of default for a while now. Its balance of payment crisis has reached to the level that the country is unable to pay for the essentials. There were reports of cargoes full of essentials like medicines waiting at ports as the authorities were unable to pay the bill. State Bank of Pakistan had said that by February 3rd, the country was left with only about $8.5 billion of foreign exchange reserves. The country is currently holding talks with the IMF to save its sinking economy. When a country defaults of foreign debts, it tries to negotiate to pay back by restructuring the debt. In that case, creditors will have to take haircuts, slash interest rates, and bear some of the losses. But in extreme default conditions, like in Sri Lanka, the foreign creditors will often take much harsher steps, like pursuing claims on defaulted countries' assets. Last year, Sri Lanka had to hand over Hambantota port to China on lease for 99 years. A sovereign debt default has multiple consequences on the country's economy. A default may lower the net asset value of bonds related to the defaulted debt. On the other hand, it can also attract more distressed debt investors who are likely to capitalize the lower prices of the bonds. Therefore, a sovereign default leaves both winners and losers.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.